Let's talk to Julie Biel of Kayne Rudnick. Julie, welcome to the programme. Stocks are higher, bond yields are lower. Can we sit on the bond piece of things first? It felt like things switched on Friday in the back half of the session where investors began to price in lower growth and lower yields. What do you think is behind the move?
Well, I think people are starting to really recognize that, you know what, I think these oil prices are probably here to stay because there's so much damage to the infrastructure. And if that's the case, we know that there can be real meaningful demand destruction. And a lot of what led inflation, right, in the last period of the 2021-2022 period was just too much demand for too few goods. And so if we have real demand destruction for the worst reasons, right, just the paycheck is eaten so much by oil prices, it is a negative thing, but it does mean that there are limits to how inflationary this time period can be, and I think what it can mean for the overall growth of the economy.
What does it mean for how long the Fed will sit this out before they step in and do something about the hit to growth?
I do think that until we have more clear data, it doesn't make sense for them to make a lot of movements one way or the other. Their biggest problem is just that the data itself is so noisy, right? We've had so many adjustments in terms of jobs. We had all of the problems in terms of the government shutdown. It makes it really difficult for them. And I think that their upside and downside scenarios of whether they make a move, whether it's to cut or to raise, it's high. So for them, I think that there's just more benefit in being able to stand pat before really making a decision.
Julie, there's been a discussion around complacency in markets, a sense that in risk assets in the U.S. in particular, there really hasn't been recognition of some of the carnage that we're seeing expressed in oil markets, particularly physical oil markets. What's your sense of just where sentiment is right now in risk assets?
I think that most people have a lot of anxiety, and there's good reason for there to be anxiety, right? It's not just this. It's, is AI going to continue the way that we're hoping it is? Are we going to see a meltdown in private credit? Most people that I talk to, they're not having a great time at the office these days. But I think that there's a force that's more powerful than that. Let's set aside FOMO. FOMO is something that happens in college. It's POMO, the pain of missing out on a day like last year when we had post-Liberation Day and Trump said, never mind, and the markets rallied 9%. If you were not on risk assets at that time, you had a very hard time making it up for the rest of the year. There's real pain in not being in the market when things revert really quickly just on the blink of an eye. Now, it's interesting, right? Because based off of Trump's comments, people are starting to realize there's a little bit of a boy who cried wolf element to that. But I think that really limits how much people really get risk off. They can be realistic. They can have a little bit of a cash position, but they recognize that things can change very quickly. And if they miss out, it really hurts the rest of the year.
How long can this go on, Julie, before people realize that there's not going to be a quick snapback like what we saw after Liberation Day?
I think that there really has to be a recognition of not just prices at the pump, but prices through the rest of the supply chain, I think is the moment that people recognize that this takes more time than expected. And I think what's very difficult is this war feels very, very opaque to a lot of people. If you remember just the Iraq war, right? Every day on the news, you had images of what was going on there. And now we have an administration that prefers to use memes and cartoons and movie clips to describe this war. So I don't think people have any real indication of what the damage looks like and how long lasting it really is. It's very easy to kind of blow up infrastructure. To rebuild it is very, very painful. And I think it's unclear how companies can really shift their supply chains around when an input as basic as oil, as fertilizer, as natural gas ripples through the rest of the pricing.
Julie, it's always good to catch up. Thanks for jumping on for us. Julie Biel there of Kayne Rudnick.